Good morning. How is everyone? All right. Any more submissions for the homework assignment? You have one more homework assignment before the semester is finished. I have the paper here to give to you. It's also posted on iLearn. It's very short. It's only 4 problems. And it's not because they're hard problems. It's just because I know you're busy and probably you could use a small break. So this is a relatively simple assignment, but that doesn't mean the material is unimportant. Actually, this is very important material, and it will figure prominently into the final exam. Everybody have a copy of the assignment? All right. So that assignment is due on Tuesday, May 17th. That's our last class. If you can believe it, there's today and then 2 lectures next week. And no more lectures about cost analysis, right? Unless you repeat the course again in the fall. Yeah. I don't think very many people need to worry about that. All right, so we're having, that's strange. It must be locked. The projector is frozen. Freeze? Okay, that's better. All right, so the bonus quiz that we're having on Sunday, I've already told you a little bit about that. It's a comprehensive quiz, and part of the reason you're receiving that quiz is to help you start thinking about preparing for the final. And part of the reason for the quiz is because I'm just such a super nice, relaxed guy that you get a chance to raise your quiz average. So you can be ready for that on Sunday. It'll take maybe about the first 20 minutes of class or so. Our final exam is here in this classroom. As I announced previously, we're not going to have any use of Excel during the final exam, but that doesn't mean that you should necessarily not study things that we've done by Excel in the past. You know, we've done Excel because it's a way to solve things more quickly if you have a lot of calculations to do. But there may be problems that you did in the past using Excel, like benefit to cost ratios. We used Excel usually for solving those. You can also solve it on paper. And so you shouldn't read too much into the fact that we're not using Excel on the final exam. You should still be prepared to answer questions from any part of the semester during the comprehensive final. So any questions related to the announcements? What, the bonus quiz? I'm not going to say anything about the bonus quiz other than we're going to have it on Sunday, May 15th. Yeah. Any other questions? All right. We're talking about depreciation today. And so depreciation is when the things that you own get old and lose value. So on the screen here are photos of 2 different cars. Actually, it's the same car. It's the Honda Civic, but it's 2 different models. Back from when Honda was just getting into the business of selling cars. Before this, it was making motorcycles and heavy equipment. So we think of Honda as a car company, but it wasn't for most of its early years. Nowadays, Honda is well established, and if you had to choose between the 2, you'd choose probably the one on the left, unless you're into classic small cars or something. But over time, even the car on the left is going to become less valuable because of the wear and tear on the machine and just its natural aging. And so in cost analysis, we keep track of the loss of value of materials for a couple of reasons. One reason is that equipment is an asset for the company. And most companies that are publicly traded have to file reports every quarter about what was their income, what were their expenses, what are the profits, and also what is the value of the equipment that the company owns. Because that's how you know what the share price is worth for a company, is you know what the revenues are and what all of their assets are worth. So that's one of the reasons we keep track of depreciation. Another is taxes. We talked very briefly about taxes last class period. In a lot of cases, taxes are lower based on your expenses as a company. And so the government isn't taxing your revenue, they tax your profit. Remember that earlier in the semester we said that profit is revenue minus costs, right? Well, depreciation can be considered as a cost. It's a way of accounting for how your equipment is losing value over time. You count that as a cost, and so it reduces your taxable income. So we call that tax depreciation. The idea that profits is income minus expenses. Well, one of the expenses that you can tell the government about is that your equipment became less valuable. And since your equipment is less valuable, you consider that as an expense. It means that you get to keep more of the profits compared to what the government would otherwise be taking in the form of taxes. So that's a big important part of depreciation, is the taxable benefits of tracking depreciation. So in depreciation, there's a couple of key ideas that we'll come back to again and again, and one is, what was the starting value of the equipment? And so the cost basis isn't just the initial purchase price, and that's the majority of it, but your cost basis, where you're saying how much the equipment was worth in year zero, when you first started owning it, you have to also take into consideration the training costs, if you had employees that had to receive some classes to begin using it. That goes into the cost basis. Also, there's the expenses of installing the equipment. So if you're talking about an electricity generator, like a backup generator that they'd have next to an apartment building, it's not just the generator itself, but it's the delivery charges. It may be the concrete pad that the backup generator is put onto. It could be the cost of wiring it into the building's electrical system, and so on. So it's all of the expenses required to bring the unit online. The book value is something that varies, and the letter K here is meant to represent some year. So the book value in some year. So the book value in year zero is the cost basis. When you first keep track of how much is the item worth, when you barely just paid for it this instant, you assume that the book value, the value of the equipment that you keep on the books, meaning the accounting ledgers that totals up the assets of the company, well, it's equal to the book value is equal to the cost basis at year zero. But the book value is going down. And let me draw a couple of curves. Here is time on the x-axis, and on the y-axis is the book value, BV. Sometimes, for simplicity, we assume that book value goes like this. It's a straight line starting at the initial cost basis, B, and then terminating at 0. And so we'd call this like the end of life. So the graph that I've shown here is assuming that there's no salvage value. So that's one idea. Sometimes if the equipment does have a salvage value, though, it changes the shape of the curve. So for instance, the curve would go like this, and then you'd sell the item for the salvage value. Now this is a linear relationship that I've drawn so far, and that's a little bit oversimplistic for how the real world works. If you've ever bought a car, for example, you know that there's an old saying that as soon as you drive the car off the lot of the dealership, it's already lost so much of its value. So the depreciation is fast at first, but then it tapers off. So let me draw what that might look like in the case of a car that's beginning to lose its value. So its book value goes down fast initially, and then it starts to flatten out. So you can buy a car and just only keep it for 3 years or so, and you're experiencing a lot of depreciation during those first 3 years. But a vehicle maybe is lasting for 10 or 15 years before finally you have to replace it because it's not economically viable anymore. So if you want to be maybe a little bit more efficient in how you use equipment, you let someone else pay for the depreciation, and then you keep the car for the second half of its useful life, where it's not depreciating very much. So this is called the declining balance curve. And we're going to look at both of these ideas today in class, the idea of a straight line, which assumes a linear depreciation, and declining balance. And the idea behind declining balance is that depreciation is fast in the beginning, but then it slows down. Now, not all depreciation can be tax deductible. And in countries that experience corporate taxes, which is most of them, the equipment can only be depreciable if it is used in the business or held to produce income. So some people own their own personal business, like a family business. And you can't buy a house in the name of the family business and consider that house as a depreciable expense because you're living in the house. You're not using the house to produce income. So the same thing is true about a personally owned vehicle, or if you want to buy a jet ski or a boat. You know, those sorts of things you can't just buy with the company money and then depreciate it because they're not producing income. The other thing is it has to have a determinable useful life longer than a year. So some equipment or some purchases have an infinite useful life, like land. You can't depreciate land because the land isn't losing its value as you're owning it. And the same thing is true of things that have a really short useful life, like food. You can't depreciate the cost of food because it's consumed in less than a year. So the equipment has to sort of be in between those two extremes, in between own it forever and own it for a very short period of time. Okay, so criteria 3 is that it also has to be something that wears out, becomes obsolete. So you can't depreciate equipment if it's not really becoming obsolete over time. Diamonds. Even if you were using a diamond in an industrial process, if it's not consumed by its use, then if it's not being worn out through its use, then you couldn't depreciate something that lasts forever. And the fourth criteria here is the inventory that you're selling. If you're a shopkeeper, you can't depreciate the things that you're trying to sell. The inventory itself is considered as an asset, but not a depreciable asset. So let me take a pause here and ask you a question. We said that depreciation is your assets are becoming less valuable over time. So let me ask you, why would a business want their property to depreciate? Why is that good for a company to have their property depreciating? Okay, yeah, so if a business is is selling things to other people, then you know the company that sells equipment can't sell more equipment unless it's wearing out. But what if you're the owner of equipment? If you are owning equipment, why are you glad to have depreciation? Mm-hmm. Exactly. Yeah, it's the tax benefits. And so what we'll see is that in business, that's actually a really important strategy that accountants are trying to do, is they're trying to accelerate depreciation. Money today is more valuable than money in the future. So what accountants are always trying to do is have as much depreciation today compared to in the future. So an accountant would look at the straight line model and say, that's not as good as the declining balance model, because the declining balance model is giving you more of the depreciation in the early years where cash is more valuable compared to in the future. So the accountant will always tell you, let's depreciate as much as possible as soon as we can, because today's money is worth more than the future money. So here's that straight line depreciation that I was telling you about. Straight line depreciation can include a salvage value in some terminal year n. The amount of depreciation is equal each year. That's why it's a linear relationship, is that for every time step you're having the same increment of value loss. There's another method called declining balance, which is that curved approach that I showed you, and in most cases the declining balance is not considered directly. On the handout I'm giving you for today's in-class exercise, there's a formula where you can indirectly account for the salvage value. But that's one of the differences between the two methods, is that salvage value is sort of a direct consideration in the case of the straight line method. So instead of having a beginning and an end amount for straight line, what you do in declining balance is you consider a depreciation fraction. So you say, every year I'm going to lose, for example, 20% of the value. And so rather than having a constant amount, it's a constant fraction that is lost. There's a third system that we're going to talk about next week when we get together on Sunday after the bonus quiz. We'll talk about the general depreciation system. And it uses pre-existing tables, and so that you don't have to do quite as much exhaustive calculation. You just look up equipment and its depreciation is based on its category. So we'll get into the details of the general depreciation system on Sunday. So here is the terminology that you need to know to apply the formulas that you're going to see in the handout. So we've gone over most of these things already. There's the cost basis, which includes not only the expense of the item, but bringing it into service costs. The book value is for whatever year you're in, whatever year T or K, whatever the variable is used, the asset's value in that certain year. N is considered the useful life, how long the equipment is going to be lasting. And the market value and the salvage value are often used interchangeably. The difference being that the salvage value kind of assumes that you're just junking the item, that it's not going to be used by anyone. You're just extracting maybe the metal value of it, whereas a market value is if you're actually going to sell it on the open market. Depreciation rate, D sub T, is what you'll be calculating from the formulas that are included on the in-class exercise handout. The depreciation rate is used in the declining balance method. It's not used in the straight line method. This half-year convention is something I'll address again when we are talking about the general depreciation system on Sunday. All right, so here's the formula for how to calculate the amount of depreciation you have in a given year. It's very easy. The beginning value, the ending value, divided by n. So it's just saying if you have what you know is the starting value, the end value, this is how much is lost, the total loss amount, and you know the total amount of years, then you calculate the loss in value per year according to this formula. And so if you want to know in any individual year how much the equipment is worth, then you can have the starting book value multiplied by whatever year it is, T, multiplied by the depreciation amount for each year. So if you want to know halfway through the useful life what is the value of the equipment, then you'd find the depreciation per year and multiply it by how many years it's been. That gives you the cumulative depreciation, the second half of that term, and then the first half was just the starting value. So again, in straight line depreciation, it's considered straight line because the depreciation amount is the same for every year. So here's an illustration of how straight line depreciation works. If you have a first cost of $20,000 and a $5,000 salvage value after 5 years, then what we would do is find out how much depreciation you're losing each year. So the difference in the starting cost and the ending cost divided by how many years the equipment lasts for. This means that there's $15,000 of value that's being lost over 5 years, and that's $3,000 of depreciation each year. So if you want to know in year 3 what is the value of the equipment, then you can say the starting value minus $3,000 per year, and 3 years have elapsed. So that's where the $11,000 comes from. And then here's the illustration of book value versus time. So straight line is really straightforward. Declining balance can be a little more tricky though. There is a fixed percentage. Sometimes this fixed percentage D is stated directly, but more often you have to calculate D based on a percentage that is given according to this formula. So D is the amount of loss each year, and so it's typical to say in these problem statements you'll see in the book or in examples from the book, to assume 200% declining balance. And the 200% declining balance, the way that you'd use that is you put the percent that's quoted in the problem statement in the numerator, divide by 100, and then n, the number of years that the equipment is lasting for, is how you calculate this lowercase d. Yeah, no, 200. Yeah, good question. Now, if the problem statement tells you a salvage value, which is uncommon, but sometimes it happens for declining balance depreciation, then you calculate the D. There's an implied D from the salvage value that's given. And so here is the formula for how you calculate D if the problem statement tells you what the salvage value will be at the end of the useful life. So these two formulas are important, and you'll get a chance to use them today. So in any given year, you can know the book value one of two ways. You can either make a row-by-row calculation. So every year's book value is the book value from the previous year minus the depreciation of that year. So that's more of an Excel approach, if you don't mind doing the iteration. Or if you're doing it by hand, then you can calculate D according to either one of these formulas. You know your starting book value, and so 1 minus D to the power of T, where T is which year you're in. That'll give you the book value for year T. So here's an illustration of the kind of calculations you do. Let's say you have a truck that cost $80,000 as its first cost, and it's lasting for 10 years. The 150% depreciation is, we're going to use that 150 to calculate D, and then once we know D, we're going to calculate the book value year by year in a tabular way. So here's showing that. This is the solution that I did on Excel. So we start off with 150%, calculating D according to this formula, where we had 150 divided by 100, and in the denominator also is N, the number of years that it's lasting. So salvage value isn't given in Part A. Instead of giving a salvage value, we have this percentage depreciation. And this is sort of like a policy thing. There isn't like a physical connection to the equipment, whether you would use 150% or 200%. It's just sort of maybe an accounting policy on what percentage of depreciation you'd be allowed to use. So you can see the book value is decreasing over time, but look how the depreciation is changing. In the first year, the equipment is losing $12,000 worth of value. So that's a big loss. But the next year, it's a little lower, $10,200. And the reason for that is because each one of these is 85% of the book value from the previous year. So 68,000 is 85% of 80,000. 57,800 is 85% of 68,000, and so on. So the depreciation amount is getting smaller and smaller. Now for Part B, we had this known salvage value. So what we can do to check our work is make sure that at the end of 10 years, the book value should be down to 10,000. So we have to calculate an implied D that's based on the beginning book value and the final salvage value. So the D is calculated, in this case, 0.1877, and at the end of the 10-year time frame, we have that salvage value that we're looking for. All right, so I am going to give you the in-class exercises now. We've got a front side and the back side. On the front side of the paper is straight line depreciation, and on the back side is the declining balance. So I'd encourage everyone to work on this. Don't just lay down and put your head on the desk. You know, you've only got a couple more class periods to make it count. Learn the material. Here you go. Okay, so let me give you just a little bit of background here. We've got 3 different pieces of equipment. Our construction company has 3 assets. The assets each have a different first cost, and they're lasting for different number of years. And so we're going to be combining the straight line depreciation of 3 different items. Some of them are losing their value quickly, like is the case with the mixer, because it only lasts for 4 years, and it's going from its initial price down to 0. So you're going to have a lot of rapid depreciation from the mixer. Some of the equipment lasts longer, like the crusher. So what I'm asking for in step by step is for you to consider, when I say the total depreciation, for example in Part A, that means find the depreciation for the loader, the mixer, and the crusher, and then add it together in year 1. And so you'll see in each of these problems it's asking for these total values. That means consider all of the equipment that you still own. But a word of warning. For example, in Part C, I'm asking you to do some calculations for year 5. Well, in year 5, you only own the loader and the crusher. The mixer has already been sold. Now, probably you're going to buy a replacement mixer, but we don't know anything about that. So what you're going to be calculating is just the information that relates to the equipment that you still own in the year that's mentioned in the problem statement. All right. All right, so in Part A, as I was walking around, I think everyone has the main idea that N is the number of years the equipment is owned. It's not what year you're on. So we're trying to find out how much value is lost every year. And that depends on the starting value, the ending value, and how long you have the equipment, not the year that you're in. So if you accumulate it, then you can see it's the 21,700 is all three of those equipments together. Now the book value is where you apply the depreciation. You're starting with a beginning value for each of the equipment items, and then you lose 3 years worth of your annual depreciation to find out how much each piece of equipment is worth at the end of the 3rd year. And then the cumulative is 121,000. Okay, so the other two questions had to do with the book value at the end of year 5, and the reason I asked that is I wanted to reinforce to you the idea that you ignore the equipment that you're finished with. So in year 5, the mixer is worth 0, and then you just apply the loader and crusher formulas together to find out the value of the equipment in year 5. And then in year 8, the only thing left is the crusher. And so how much depreciation you're going to have just depends on the depreciation per year for that one equipment that you still own. What? For Part D? We were just trying to find the depreciation, not the book value. Yeah. So how much depreciation is there is just that, the loss per year that you're calculating. Are there other questions about straight line? How to graph it? Good question. All right. So you know, actually you can do the graph just from this data. You don't have to use any of the calculations for the graphing. Like if we wanted to graph the crusher, then what we would do is we would put on the x-axis 9 tick marks. Here's 1, 2, 3, 4, 5, 6, 7, 8, 9. And we would have the finishing value of the crusher going to 22,400. So here is my finishing data point, and my starting data point at year 0 would be 112,000. And so we can graph it as easily as connecting these 2 points, connecting the intercept with a y-axis at the beginning book value, the first cost, and then the other point is at the salvage value at n. So that's how you can graph it. Yeah, it's the slope. It's the loss of value for each year. Right. Okay, well let's consider now the declining balance method. Here's what it says in the declining balance thing. We have roadway paving equipment, and it has a first cost of $486,000 and n equals 8 years. We want to find the depreciation and the book value for years 1, 2, and 3 according to, first of all, the 150% approach. So that assumes that the salvage value, there's not like a certain fixed salvage value. And then Part B that I've given you on the handout is that you should consider an estimated salvage value of 87,000. So this one's a little bit of repetitive calculations, but you can do it. You're engineers, right? Is there a question? It depends on the given statement. So you would use this formula where you're having to calculate D based on the percentage if the problem statement says use 150% declining balance approach. But if it tells you a salvage value, you wouldn't also, in the same problem, be given this percentage statistic, unless it's like a part A and a part B, such as it is here. Good question. N is 8. That's how long the equipment is lasting. T is for whatever year you're on. So I'm asking you to do it for 1, 2, and 3. So you're going to have for the first time T equals 1, then T equals 2, T equals 3. But N is always going to be 8. Yes? Yeah. So the problem for a declining balance problem, you will either be given a salvage value or this percentage, because you have to have one or the other to calculate lowercase d. So you won't be given both unless it's a two-step problem, like this example is. If you have the salvage value, then you'd use this formula that's under part B. Yeah. All right. Let's see, 91, 74, 60. Yep, that's right. You're getting it. So I also asked for the book value for each of them. Oh, you've got it. All right.
This one without this one.
Actually, you can. There's two different ways. You can do it subtraction like you did, but you could also calculate the...
No, I calculated this one. This one for t equals to 2.
Okay.
The previous one we take this one.
Yeah, that's right.
This one is t with 1.
Right. Okay, good. Yeah. There's two different ways you can do this. You can either calculate the book value by doing the depreciation and then subtracting it each year. And that's what I did on this first one, where I was saying the book value is 486,000, which was the initial book value. And then I subtracted the depreciation, which I had calculated as 91,125. So you find the previous book value and subtract the depreciation. Or you can just use the formula directly. So you see on year 2 where I was calculating the book value of 486,000, and then I did 1 minus this d factor squared. So you can either do it by subtraction or using the formula. The salvage value part, you have to calculate an implied d. So this lowercase d is implied by the beginning and end value of the equipment. And so the procedures are the same, it's just you have a different lowercase d because you're trying to achieve a certain salvage value at the end of the useful life. Yeah. So for the homework, I think since there's only 4 problems, I think you've got maybe 2 problems that are straight line, 1 that's declining balance, and 1 that's according to the stuff we're going to talk about on Sunday. So if you wanted to get an early start and just finish things now so that it's not on your mind later, you could solve 3 out of the 4 homework problems probably in the next 30 minutes after class, if not less. Any questions on today's in-class exercise? Part B. So in part B, the D value doesn't come from the percentage. In part B, what we're doing is we're calculating this lowercase d value based on, it says the salvage value is 87,000. So we put that S into the formula because we're trying to calculate a new lowercase d. And so everything is the same, it's just we're using a different lowercase d. And the reason why we're using that different lowercase d is if we carried this through and did the same thing all the way through the end of the 8 years, then the book value at the end of the 8 years would be this salvage value of $87,000. So this D is what you have to use to get the book value at the end of the time to match what you want it to match. All right, so the big ideas for today is like what is depreciation, why it's important, why do companies like depreciation, and then of course how to calculate it. All right, that's it for today. I will see you on Sunday for the quiz. Have a nice weekend.